there are some changes in the regulatory framework around in countries that will unleash a new industry. So let's do a deep dive as an example here. The good one is what's happened is before 2018 in the US, online sports gambling was not allowed, so it was illegal. All right. So what you heard is that in 2008 towards the 2018, sorry, beginning of 2019, the Supreme Court in the US ruled, right, and made it legal for online sports betting and iGaming. And what that did is that it paved a way for the creation of a new industry in the US. So although the regulation was changed at a federal level, the actual implementation of the new iGaming or sports betting and iGaming industry was left to the various states. And I think somewhere in the second half of 2019, New Jersey as a state was the first, to provide a regulated structure. And what we are seeing now is, since then, over the last 2 years, more and more states are making this illegal in the market, and then the iGaming market is being born in the US. So you see that just by following some of these trends in terms of regulatory changes, that's how markets are born. And then you as an investor, right, what you need to do is always to keep up, reading, and always to keep up, with the information of how things are evolving in those particular markets. And then another way that you have to think about it is, which I really really quite find effective, is you have to establish a network of fellow investors around the world. Because if you're sitting in South Africa, or for myself when I'm sitting here in Australia, you can't cover the entire world from one perspective, right? So establish a network of people that you can always talk to. You can get on the phone or Zoom call with people in Europe or in the US, and you can share ideas around which industries are they seeing emerging on their side. I mean, I've done that quite a few times, and that's how I came across industries such as you know the one that I really like also around the organ transplants, where companies are now investing quite heavily in the concept of bioconvergence, which means mixing biology and engineering in order to construct new organs that can be used to do organ transplant in patients. So I think, in a nutshell, that's kind of like how you have to think about it, and how you have to look out for the opportunities which are around the world.
So once you've identified this, industry and sort of sector and the regulation that's happening, what do you do with this information? I think for me that's where my thinking is. So, you've recognized that this is the industry, this is the sector. What sort of do you then do with that sort of information once you have it?
Yeah, I mean, the way that I think about it is that to be a very good investor, you must be able to connect the dots. So you have to be able to connect the dots, which means that you can read 5 or 10 different different, whether it's books or newspaper articles or the blogs, and then connect the dots and find new investment opportunities. All right. So if I come across the whole concept that the US market or the Federal Reserve has made it, so the federal government, so the Supreme Court have made it legal, for online sports betting and iGaming in the US. So that's one article that you come across, all right? And then sometimes when you're reading on a blog, or whether it's a newspaper article, whether it's Wall Street Journal, the Financial Times, or whether you're reading an article in the Globe and Mail, which is the Canadian business portal, or whether you're reading some of the business portal here in Australia, to be the most effective investor is you have to be able to connect dots between two different topics that might seem unrelated on face value. So let me give you an example, right? There's one point where I did read about sports betting in one separate article, that we're talking about in the US. And then somewhere in a different article, in a different book, you then come across, new company, not effectively new companies, some of the companies that are doing well in that particular market. So if you look at sports betting, right, if you easily Google sports betting or online gaming, right, or iGaming, you can easily come across a company like Evolution, which is a company based out of Sweden, and they've done extremely well over the last. I think they are close to being 100 bagger or 10,000% return over the last 5 years. And you can see that the company knows, the business quite well, and they've done quite well in Europe, right? Because in Europe it was legalized, so they were able to grow there. And as soon as or as soon as sports betting was made legal in the US, the first thing that the company did is expand to the US market. So you can easily start connecting dots, right? So if Evolution knows the industry quite well and they've done quite well and they are pushing into the US, then you can be able to connect two separate dots, right? And you can start looking at the company and the opportunity that's in front of them. Um, the same way can apply, if you look at some business models where, let me give you an example. I think over the from 2010 probably, from 2015 or so, I came across a company called Mercado Libre, which is a Latin America based e-commerce and fintech giant. All right, and they've done quite well in that particular market, right? So you read up on the company, you understand the business model, you understand how they grow as how they grew as a company, and then you get a firm understanding of how you can establish an e-commerce company slash a fintech in an emerging market. So that's one thing that you read. And then when you do more research, right, you can then bump into a company like C Limited, and you can see that you can connect the dots and see that C is trying to replicate what Mercado Libre did in Latin America. They are doing the same within the Southeast Asian market. So you see that I think to me, what the most important attribute that you can ever have as an investor is to be able to connect the dots.
Make sure you connect the dots. It's all about connecting the dots and what's coming up in the industry. I'd like us to shift to multi-baggers. So just in terms of those that might not be aware, a multi-bagger stock is basically a share which, appreciates over time. I think it gives you a return of, 100%, 200, and really that's how wealth is created in the long run. In his book, Christopher Meyer, who wrote the book 100 Baggers, he found that there were over 300 companies which had achieved 100 bagger status from 1962 to 2014. And basically, if a company compounds annual growth, so that's the share price, if it grows compound annual growth of 14.1%, it will take that share price to become a 100 bagger 35 years. Just take us through how the process of identifying a multi-bagger and how you tend to do it.
It's a question that I've been thinking of quite lately, and I think the way that I'm now framing it in my head is there are two sides to finding a multi-bagger. So number one is, obviously you have to find a good quality company that's operating within a growing industry. And I think that is the easier part of the equation. I think the most difficult part is having the patience to hold a multi-bagger. And if you look, I think in that book that you referred to, that Christopher Meyer wrote, he quoted Thomas Phelps when he says that in order to make money in the stock market, you need to have the vision to see a good company, the courage to buy it, and the patience to hold it. And of these three, it is the patience which is the rarest of these three. All right. So buying good quality company alone, I think is relatively much easier actually, for anyone, whether you are a seasoned investor or not. I think the most difficult part of finding a multi-bagger is having the patience to live, to just buy and leave it alone. So sometimes I frame it as having the highest threshold of boredom. And when I reflect over the past 5 years, I have I've been able to find some of the multi beggars. Like, for example, I'll give you some examples. I was able to invest quite early into Tesla. All right, and I mean, I just looking at the product. Remember, we spoke about vertical improvement of a market, right? So you're taking an existing market and then you are doing something which is completely new, which was the introduction of electric cars. So I was actually quite able to find Tesla quite early, and I invested in it, but I didn't have the patience. And after about 2 or so years, my patience ran out and I sold it. Now, fast forward, I think everybody knows what happened to Tesla last year, in 2020. I think when I look back, the share price is almost up 35 times, which is like 3,500% from the time that I bought. But I didn't hold it. So the more that I think about it is, I think finding a good quality company is easy. Having the conviction to buy a good quality company is relatively easy, but having the patience to leave it alone, that's the most difficult part. And of late, right, especially over the last 2 or 3 months, I'm beginning to thinking more about the impact, especially around FinTwit, all right, because now we are so quite we are very, very active on social media. Now, the thing about Twitter right now, and what I'm also a culprit, and I've also contributed in this, is that over the past few years, every single month, people post their portfolios and how they are performing, right? And what that does is that it always forces you to compare your account and how you are performing and the stocks that you're holding versus what other people are doing. And sooner or later, if you do that consistently, you're always going to be driven to make some action, or to trim your account, or to sell this or add that, or do this trim or do that and you end up chasing chasing performance. And usually that is a recipe for a disaster. So the thing the thing about finding a multi-bagger, just to circle back to your point, is that there are two sides to it. There are the qualities that you look for in a company, and then there's also your side, which is you as an investor having the highest threshold of boredom to be able to just leave these companies alone. So let me start off on the first side, what you look for in a company. um, I've evolved quite a bit, and these days, right? Because what I used to do is that when I come across a company, the first thing I'll do is to run to the financial statement, and then you want to look at revenue growth, you want to look at profitability, the free cash flows, and all the metrics, and then you try and do some ratios. But personally, I think that is not the right way to do it for a number of reasons. Um, Reason number one is that financial statements are backward looking, right? So you are seeing what the company has done previously. And one thing that I've evolved over the past couple of, especially probably over the last 12 months, is that if you want to look at a company, how it has evolved from a financial perspective, you get into a point what I call anchoring. Anchoring just means that uh, you anchor on the first piece of information that you receive, and then you start framing your research on that piece of information. And number two is that I think it's now well known around the concept that intangible assets don't really screen quite well if you look at the financial statements, because of how how accounting rules are structured. So the way that I think about it now is that if you come across a company that you potentially like, you have to spend a considerable amount of time understanding the product, what the company really does, what product do they produce, what solutions do they produce, how is it distributed, and how is value created and how is value captured. All right. And spend time really understanding the solution or the product. And if you are in some markets, you know, I know some people who actually go out and try and use the product so that they can have like a first hand experience around product usage and talk to, you know, people, whether it's people on the streets or talk to customers or to suppliers, you know, to understand from their perspective how they view that company product and solutions. And once you do that, right, it gives you a very, very good framework around, you know, knowing how value is created and how value is captured. And then when you go into into the company's financials or filings, right, what you are going to look for is you're going to look for the translation of that into the numbers, right? And understand, you know, okay, so if this company, for example, is saying that, you know, let's take, for example, let's take Walmart, right? When Walmart was listed, the company, I think, is for the first 5 or so years, it really was, the share price was really struggling. I think it spent 5 or so years below, you know, below its IPO price. But if you look at the company itself, or if you did primary research, right, around going to a Walmart shop, you could see, number one, you know, a lot of people were, you know, gravitating towards the Walmart retail stores. You could see that the company was expanding in terms of the number of new stores that were opening. You could see that, like at every unit level, if you look at at one particular store, the company was growing, right, in terms of foot traffic, in terms of the number of people that were coming to shop. And then, so you understand that part first, and then you can move to the financials. All right. And in the financials, just to reiterate the point, that you must also appreciate that accounting rules, you know, change how financials are done. So I think what's important in the financials is to dig deep a little bit and find out how the company, whether the company is profitable at a unit economic level, and then try to frame that thinking to say, okay, if Walmart, if it takes Walmart like 6 months, right, to recoup or pay back the investment that it requires to open a new store, you know, how big can this thing grow? And then you can do some back of the envelope, you know, calculations, you know, and see that, you know what, um, this actually can be a potential big company because the business model works and the unit economics works. So if this company expand at this rate, you know, it's going to be a multi-bagger. So that's kind of like how you have to think about it. And in terms of reiterating, I think it's quite important to understand the company's solution and the company's products. And then there are also some businesses that probably the technology might be too hard to understand. All right, try and reach out to some people in the field. So if it's a software or cybersecurity, as an investor, you can go on a call, you can talk to a friend who is in the IT space, ask them about, you know, about CrowdStrike. Have they used the product? Yes. How do they find it? How does the product work? How does it compete, you know, compared to other solutions that are out there in the market? So always reach out to people that are in various industries and understand the product and understand the solution and how it works and how users think about it. And then you, from that base, you can then start looking at the company's financials.
Wow, that was loaded. I was taking notes as you were speaking. So, you've looked at the financial statements, you've looked at this company. When do you decide to top up to dollar cost average, which is basically, you buying at different times? When do you decide whether you're going to top up or continue to let it run? And when do you exit?
Um, I think for individual investors, it's a little bit easy because most of us, right, we work a 9 to 5 p.m. job, and as a consequence, we invest monthly, you know, just a bit every month. So for individual investors, I think it's relatively quite easy because the nature in which we get our income allows us to dollar cost average over time. So if you find a company that you like, you can decide, your comfort level, how much you want to invest. And I mean, my guess on face value is that probably 99% of the people, because we earn, and then you take a small portion of your salary that you invest, so it forces you to invest in that company, over time. I think what's the most important to me is that do your homework in terms of the company, and find your comfort level. And when you do that, invest over time. Um, and I think it gets a little bit, probably, e- let me say, like, probably more. Sometimes there's a psychology to it, right? Because sometimes when, let's say you want to invest $20,000 in one particular company, but your income allows you to invest 3,000 per month, so obviously it takes you 7 months to build up that position, right? And I think that's the advantage that retail investors have, because it's like dollar cost averaging is forced upon you, by circumstances. The way that I do it myself is I also do a similar thing. I normally establish a startup position. All right. So if I find a company and I'm still doing my homework, sometimes I just establish a startup position, which is like 1% or two, or between 1 to 5% of my of the capital that I want to commit to that particular company. And then once I do that, I spend the next couple of weeks or months digging deep and reading as much as possible. Talk to people. I think that's one of the most powerful things you can ever do, um, like within this industry, because there's no way you can know everything. All right, so talk to people that are expert in those particular industries. They can confirm your thesis. They can also give you a different things. They can also give you different things to think about. And then the more comfort that you have, you keep on adding to your particular position. All right. And one of the things that I also should highlight is that there's the another psychology to it sometimes, is that there are times when you invest in a company that you are quite bullish on, and the company can do absolutely nothing for 4 or 5 years. And it comes back to that point around having the highest threshold of boredom, and always not continuously comparing yourself to a particular, to other investors. I think I had that particular experience with Square. There was a time when I think it's for 2 years or so, the share price was almost stuck at $60 per share. All right. And it wasn't going anywhere. So here, my advice to investors is that even if a company's share is not going anywhere, what you need to do is to have a spreadsheet that you keep track of specific company metrics, that you are keeping track to see how the business itself is like how the business itself is doing, right, in that particular period. One good example which was given was, I think it was McDonald's, if I'm not mistaken, right? There was a time back like some time long ago, when the share price didn't go anywhere for about 5 or 6 years, all right? But if you remove that part, and you don't pay close attention to that part, if you look at the company metrics, so if you look at revenue, if you look at earnings per share, if you look at cash flow, everything was improving. So the business itself was doing quite well, but the share price was not going anywhere. All right. So the way that I think we have to think about is, we have to move away from monitoring a stock price to start monitoring a business, and see how your thesis is playing out. So if you like to invest in, say, let's say Afterpay, which is an Australian buy now pay later platform, always keep track of the business, how the business is doing, customer growth, active customer growth, the average spend per customer, how much revenue is the company generating per customer. If those metrics are improving, all right, or they are growing with time, that is the business that you must hold. regardless of how the share price is performing. Because one thing that I just also wanted to highlight is that 100 beggar or these 50x beggars, they're actually what we call back-ended shares. And what that means is that a share price, like in my previous example, how Tesla was, is it can do nothing for 4 years, and then in 1 year it went up 20x. So you can see that some of these share price, they are back ended, and if you're an investor, if you're not paying attention to the operating metrics of the company, and all you do is pay attention to the share price, you are bound to you are bound to be moved and make some adjustment to the portfolio or to your portfolio, which is not necessary. So pay attention to the company, pay attention to how the operating metrics are going, and so that would obviously leads to the question that you asked around when do you sell. Simply sell when the operating metrics are deteriorating. That's the best time to sell. If not when the share price goes down 20 or 30%, that it doesn't matter how much the share price go down by. You as an investor, I think your interest or your focus should be on how the company is doing. If the thesis is not holding and the company's operating metrics are deteriorating, then yes, you should sell.
Thank you, Trev. That really answers. A lot of us investors love to look at the share price and not the business matrix. So just to summarize what you've said, rather look at the business matrix and not the share price. I just want to maybe take us into your confidence, if you will. How many multi-baggers do you have in your share portfolio?
I mean, I have quite a few, but I'm not yet at 100 bakers. So the highest that I have is Square. I think it's now up almost 1,500%. So it's like a 15 bagger. So that's the highest that I have in my personal portfolio. I have quite a few that are 600%, 700%, 800% or so. So I mean, I really appreciate that I'm still quite new and still quite early into this journey. I really started, changing my perspective around investing around 2016. So it's been 5 years. So it's really quite new. But the way that I'm also involving as an investor is really to have that long-term outlook, and to try, especially for myself, all right, to try and increase my boredom threshold, and to be able to look for companies that I'm quite comfortable with the company. And if C Limited drops 30% today, I wouldn't care. All right. I'll still go on with my day without having some palpitations. Same thing with some of the companies I hold. If Square goes down 20%, again, I wouldn't care, right? Because then I'm quite comfortable in the business model. I'm also quite comfortable with the how big that particular market is. So that's kind of like how I'm thinking about it lately. And I also want to try and have self-discipline in terms of not chasing every single stock that you find out there. I think there are over, probably 10, 15, 20,000 stocks around the whole world, right? So you can't buy everything. So you must also have the discipline to know that you can't buy everything, and not, don't allow FOMO, to always drive you, so they're always chasing performance, and end up having a portfolio with 100 small position, or a huge number of small positions, because you're just chasing around everything. So it's okay to miss some of these stocks, and to be a good investor, you must actually be able to celebrate, and uh, being okay be have it, or be okay with not to have invested in a particular share and see it grow 10, 20, 30, 40 times, right? Because you can't have your hands in every pie. So I think that those are some of the things that I'm learning, and also some of the things that I'm trying to to do, like, how I'm trying to improve myself like as an investor.
Don't have your fingers in too many pies. I think that's the key message I've taken away from there. I just want to shift the conversation just slightly. I think you and I always talk about, this concept of generational wealth. I know for me, certainly, I'm the first in my family to have gotten a good education, to be a working professional. And I also want to create something not only for myself, but for the future generation. And one of those ways I've identified certainly is investing, and investing in, in exchange traded funds, and investing in various things. And one of those ways you can create this generational wealth is through identifying multi-baggers. What is your view on, just using multi-baggers as a way of creating that generational wealth, which some of us are late to the party and they're just trying to catch up?
Yeah, no, definitely, definitely. I mean, I was quite fortunate to come across. I think you and I have discussed offline, but to come across, there's a family based out of Sweden called the Wellingberg family. They are based out of Sweden, and I think they typify exactly what we are talking about around building generational wealth. The background story is that I think the founding father, or at least from this particular family, you know, it was something around 1870 or 1880. So it's more than 140 or 150 years ago. And what they've been able to do is they were able to create like an investment company. It's called Investor AB. That is their, I think that's their anchor company, and then from there they've got other companies. One of which is called EQT Group AB, and yeah, I think the main one is called Investor AB. That's the investment vehicle that they use. But what they've done is that they have grasped the whole concept around let compounding work for your favor. And if you look at their portfolio in their key company, Investor AB, on average, the companies that they hold, on average, they've held those companies for something between, let's say, 60 to 100 years. That's how long they've been holding those companies. Um, most of the big European companies like AstraZeneca, Ericsson. If you look at some of the big companies within Germany and France in Europe, so they've held them for between 80 to 100 years, right, on average. And the beauty around it is that you let compounding and time do the heavy lifting for you as an investor, and then they then use, obviously now these companies are quite big and they pay a lot of dividends, so they then use that dividend income to further diversify and invest in new technologies, right? So they, through their significant shareholding in a listed company called EQT Group, they invest in startups, in venture capital, in private equity, etc., etc. But one thing I really, really admire about them is twofold. Number one is the Wellenbeck family, right? Uh, they treat their investment vehicle, their family investment vehicle, you know, as an institution. So they've institutionalized everything from the process around how do you select the money managers, how do you select the people that run the companies, how do you select investments, how do you deal with family dynamics around shareholding. So they've institutionalized the entire process, right? And because of that, generation upon generation can come and go, and the company or the investment vehicle still holds. So number one, I think it's around institutionalizing the entire process. And number two, they have been able to incorporate. So as a family member, if you're lucky enough to be born in that family, right, you are introduced to the whole company at a very young age, and you are required, either to work in the investment vehicle or the underlying portfolio company, so that you can have a very good appreciation around how they manage their wealth, all right, as a family member. Um, and what they have done, I think, if I'm not mistaken, is that normally the actual investments, eh, the family members don't actually do the investments. What they do is they hire external. It's part of their strategy, so they hire external independent people to manage that. But the family members are involved at the board level, right, where they have to make the key decision. So to me, I like institutionalizing it, and I always say that one of the drawbacks that we've had, most of us, whether it's at an individual level or at a societal level, is that we don't have institutions. All right. And if you don't have institutions, it becomes extremely hard, to pass on, whether it's a legacy or whether it's a company, or whether it's a business, from one generation to the next. So it's something that, I've started to work on myself, create institutions, create processes around institutions, and get your family to buy in and also participate, so that they can get a very, very good understanding of the why you are doing it, and carve out, within that institution, how each person can also pursue their own dreams and aspirations.
So, ladies and gents, I'm gonna open the floor up now for questions. If you can just maybe request to be a speaker, you can then go ahead and just ask the question directly, or you can tag us in a tweet if you want to tweet and ask the question. Trev, one thing I always get asked is, we have various people in on this session who come from different countries. And I know, we always celebrate the usual brokers that we have in South Africa. What are some of the brokers that you've used that you found efficient in terms of converting rands into dollars? Because I know you invest quite significantly in other markets besides South Africa.
I mean, I use I use Saxo Capital Markets, which is a Danish brokerage firm. They used to operate in South Africa, but they sold that franchise to a company called DMA.co.za. But still, DMA.co.za still uses the Saxo platform. So that's the one that I normally use. I think they've got a very good and robust platform, and they cover a lot of markets, right? So they've got a very extensive reach. I also use Interactive Brokers, which is obviously the US based brokerage company. I think, and then another American one called TradeStation.com. But I mean, I think right now is, I think what technology has done is that it has opened up the floodgates, and there are so many brokerage companies that are providing solutions that are making it easier and easier and easier for investors. Um, so I think in South Africa, obviously, there is Easy Equity. I think they've done a fantastic job. It's a company that I think I did share that I've now made my first investment in South Africa after a long time. So I did make my investment in the parent company, Purple Group. So I think that they've done quite well in South Africa. Overseas, there are common ones. eToro is quite common. Schwab's is also quite popular. Um, I think Interactive Broker is quite popular. So I think investors are really spoiled for choice on that front. Just talk to people that are investing, and find out which brokerage companies they are using. In terms of moving forex, all right. From this side, I use a platform called Wise. It used to be called TransferWise. Now it's just called Wise. I use them from here. They are quite efficient. Normally, it takes same day for to transfer currency, and they're relatively price competitive. I think you pay something like probably $10 or so, $10 or so, $10, $15. That's something around 100 to 150 rands in terms of doing transfer. So I think the world is the world is just getting better, and technology is simply making investing quite easy for retail investors. So just go out there and look at what opportunities are available.
Thanks, Trev. I don't see anyone that has requested to be a speaker yet. So I'll just have one more question. And if we don't have any other requests, then we'll end the session. So Trev, are you sharing, as you sharing the knowledge and stuff, how do you get your family members to start investing? I think that's one of the things. If we're going to do generational wealth, we need our family members on board. How are you trying to get your family to be investing?
I mean, it's always a tricky one, but I think it comes back to the issue around having them involved, but not from your own terms, but from their own terms, right? On how they see the world. Because investing is almost like you have to invest in a way that reflects your view of the world. So we all have got different views and aspirations. So it's all about engaging with your family members. You know, what sort of world do they see living in, and the sort of opportunities that they want to actively pursue, and then use that lens, to obviously to engage them in the investment space. I always when I speak to some of my friends or people that I am introducing to investing, I always say that, because I found that there is a risk of information overload, right? So when someone comes and say, I want to invest, how should I go about it? Normally, there's an information overload, and that will, probably um, scare or put a lot of barriers in front of the person, right? So what I normally do is that I just say, okay, you want to invest, but what I'll ask you to do is I'll send you, let's say, a message with 3 steps of what you need to do, and I want you to invest like, $100 or whatever amount, like even 500 rands, whatever amount is, because once you've got skin in the game, it changes your perspective, right? And it changes your interest, because now your money is on the line, so it changes your interest. So try and have them invest very little amounts of money, whether it's 300 rands or 500 rands. But once they have got skin in the game, is I've heard people where they say, I want to invest. I say, okay, do this next, follow this next steps and invest, $200 or $300, and then let's talk after 2 or 3 weeks. So they do that. They invest $200. So they said, which company should I buy in? I just say, you know, I don't know, like, take it, just close your eyes and choose whatever you want to buy, but just invest $200, or $500, 500 rand, sorry. Um, and then they do that, and they say, I've bought some shares in Netflix, or in I don't know, whichever company it is. And then I'm like, okay, that's fine. So let's talk after a month, right? And my experience is that it doesn't take more than probably a week, and then that same person will be like, texting me and says, you know what, I was just driving to work, and then I saw this big Netflix billboard, and I think it's a good company. Now they want to tell me about Netflix, right? So then they go on and on and on and on and on. But I think the key message is that you just need to have some form of skin in the game, and then it really really just changed the way that you think about it.
So it seems, Trev, it seems our listeners are able to request to be speakers. I don't know if the issue is on my side, But I've gotten quite a few telling me that they're unable to request to be a speaker, which is a bit frustrating. If you're trying to sort of become a speaker and you can't, please just raise your hand so I can see if it's a big problem, if the problem is on my side, maybe. Please just high five or wave or something so I know that okay. Yeah, it seems to be an issue. So I've got one question. I don't know how to try and fix this problem. If anyone knows, please maybe inbox me. But from my side, I don't know if there's maybe something that has been disabled that I can't see that inhibits me from making people speakers. I have one question that I got from Chimwala. He's asking, how do you screen the tens and thousands of stocks globally to narrow down on the ones that you decide to research? And how long does the process typically take to be comfortable to make a significant, for you to take a significant position? That question was from Chimwala.
Can you repeat the second part?
Okay, let me just go back to the question. Sorry, I sort of went out. Just give me 2 seconds. So the first part is how do you screen the tens and thousands of stocks globally to narrow down on the ones that you ultimately decide to research on? And then the second part is how long does this process typically take for you to be comfortable before you take a significant position?
Sure. I mean, the issue around screening is a very, very interesting issue, right? Because there are financial tools that you can use to screen um, for various stocks. I think Yahoo has got one. I think Google has got another one. So there are various screens that you use. That a person can use to screen. So you can screening just means that you can put some variables, right, and then it can spit out the results. Um, Personally, this is now a personal experience. I've never really used them, simply because some stocks screen quite badly because of the nature of the company, or how the company operates. So some companies screen quite badly. What I found in terms of how do I narrow down on my opportunities, actually, I but I mean, as again, this works for me. So people, I think the key message is do what works for you and do what you're more comfortable with. What works for me and what has been working effectively for me is that I have been able to build a network of contacts around the whole world, right? So that I talk to constantly every other day. So I've got network people that I also met on Twitter, or some of them connected through other ways. So I usually have about 4 or 5 sessions a week where I've got a Zoom call or a chat with someone, whether they are based out of the US or Canada or out of Europe, whether it's England or Sweden or France, like whichever country you can pick off. And I just ask them, like, what sort of opportunities are they seeing on the ground, right? Because there's something about being on the ground that just helps someone in terms of identifying opportunities that I can't find, or I can't screen. Sometimes you can't screen those opportunities whilst you are based on the other side of the world. So I do that quite extensively, 4 or 5 times a week. I have, always follow-on calls or scheduled calls with contacts around the whole world. And number two is I've defined a subset of companies that I am more comfortable, like doing a research on, and some companies that I really just struggle. So, for example, I mean, I have I really struggle with biotech companies. I really struggle with, uh, you know, um, probably like mining or commodity companies. So there are some sectors that, but this is just me, that I really struggle with, and I know that I wouldn't have much of the conviction or the the drive to do some research. So I think each individual investor, knowing your strengths, you can build on that, and then just just be comfortable about the companies or sectors or type of companies or type of business models that you really like. So that's how I screen my opportunities. I read a lot. Number two, I talk to a lot of people. I talk to a lot of people always, and we discuss and we share ideas. And I think probably in the last 6 or 12 months, 80% of the new ideas that I got, it was simply by talking to other people, just by connecting and and also getting that access or that lens from their perspective. So that's the first thing. In terms of research, right? Normally, I mean, it normally takes me sometimes probably let me say 2 weeks to a month, right? To read up on a company, and um, so I read up on a company. If it's in a space where I can try the products, I'll do it. Sometimes some companies are based in a jurisdiction where I can't try the product. So if I've got contacts again, I can actually go on the call and say, to a particular friend, if you heard about this company, have you used it? So I did that one with a company called Good Food, which is a Canadian online grocery company, where I went on a call and had a conversation with a couple of people in Canada. Have you used it? How has been your experience? Is it a good, like, from a product perspective? Is it something that you've enjoyed using? Um, so that's also another powerful way that you can always do it. So yeah, it normally takes me 2 to 4 weeks, but um, there's a psychological edge around it. So what I normally do is that I normally can invest something you know, like $1,000 in that particular company, even after reading about it just for 1 week, so that I can have some skin in the game around that concept around have skin in the game. It changes your psychology around it. So have skin in the game, and then I start building up my position with time. Sometimes it takes 2 or 3 or 4 months just to build up a single position, or sometimes it takes much longer, but that's kind of like how I do it.
Okay, just to note, I'm having technical difficulties. I've invited a few speakers, but I don't think the invites have gone through to them. So let me try something. I'm trying something to edit the settings, Trev, so that we can just allow a few people to ask questions. But I've got questions from Tabang, the JSC guy. So I'll just read that question through to you. So he's asking, which sectors do you think will grow in the next 10 to 15 years? Since you can't mention actual names.
Yeah. So in terms of sectors, right? Right now I'm looking at online sports betting and iGaming. So that's the first one. Um, the current market, especially in the US, right? Like I said, it has only just been legalized. So I think the current market in the US right now, in terms of revenue, is around 1.5 to $2 billion. That's kind of like where it is at the moment, because it's hardly a year after it has been legalized. So that's the first thing, and then it was obviously affected by the pandemic, since most sports were suspended for quite a significant period of time. But just to give some color around it, so online sports betting and iGaming in the US had been happening for a long time, but it has been happening under gray or illegal settings, and the estimates around total revenues in that particular market is around 150 billion to about 200 billion, right? So people have been doing it, but they've just been doing it, you know, within gray areas or illegal areas. So it's a market that, now that it has been legalized, and some states have started rolling out in terms of the market structure, I believe that Right now, I mean, it's at 1.5 billion. So it can just show you that the potential penetration right now is less than 1%. And the combination of it being made illegal, and number two, um, the obviously the rise of the mobile technology. So I think this is a market that's going to grow. The legal market is just going to grow and it's going to take share away from the illegal market. So that's one space that I'm looking at. Another one that I am looking at is in terms of the bioconvergence, which essentially is an industry that connects biology and engineering. And one of the key issues that they are addressing is around organ transplant. If you think about it, simply not an effective way of doing it. So there are millions and millions of people around the world that simply died because they were waiting for an organ transplant, right? So we have companies. I can talk about it because this one is outside of the market that I cover. So there's a Swedish company called Cell Inc. And they are almost like a leader in this particular space, and they're developing the 3D bioprinting, uh, you know 3D bioprinting technology. And in the end, or the long-term play here, is that they want to get to a position where if you just need a heart transplant, right, they can use your own tissues and they can do a 3D bioprint of your own heart, and then you can easily get a transplant. So that's also one area that I am quite interested in. Um, Other industries or other sectors that are evolving is obviously, I think everybody knows now. Uh, there's there's e-commerce, but what I'm more interested in is probably not e-commerce per se, but it's drones, or the evolution of drone technology. There's a company in Norway called Nordic Unmanned. They are developing drones, or no, they're developing drones in the whole industry. I think that's one is going to grow quite substantially. Drones have been used mostly for the military applications, but now there's been legislative changes in Europe. I think it was earlier this year, if I'm not mistaken, or late last year. There were legislative changes in Europe that now allows unmanned drones, to be used for commercial and retail application. So drones is also another area that I'm quite interested in, and I'm following quite closely. I mean, the other areas are the normal culprits. So you've got e-commerce, you've got fintech, you have got, within the payment space, which is the war against cash. So I think those ones are well-known trends.
Sure, Trev. I've got quite a number of questions. I'm going to try and go through them. So the first question is, where can we find companies that produce stock tips and reports as a starting point?
Um, I've got a very disappointing answer because there is no one particular place where you can go and find them. I mean, I have been asked that question before, and unfortunately, I always give the same boring answer. There's no one place where I can say go to place ABC, and then you can find them, right? So it doesn't exist, right? Simply doesn't exist. Otherwise, if it did, everybody would be there. So it circles back to the initial point that around that you must just be a ferocious reader, and you must be able to connect dots. So read as much as you can, or whether it's the common business platforms, whether it's Bloomberg, Wall Street Journal, whether it's Financial Times, whether it's in Canada, they've got there's some specific country-based very good platforms. Like in Canada, they've got one called the Globe and Mail. Here in Australia, they've got one called AFR. So there are some specific um, uh, newspaper or platforms, and then number two, there's also a rise in terms of what we call paid research for that is being targeted for retailers. Um, in for example, in in the Nordic space, like Nordic countries, which is Sweden, Finland, Norway, stuff. There's a company called, I think it's Red Eye. It's REDYE, I think. Yeah, REDYE.se. All right. So it's essentially a research platform where you can pay something like 170 rands, if I'm not mistaken, 170 rands per month, and then you get access to quality research around opportunities that are within the Nordic space. All right. The same thing happens within the US. Obviously, there's a company called Seven Invest. There's the Motley Fool. Full disclosure, I work for the Motley Fool. So this we also do research that we send out to individuals that are members, right? So you can subscribe. I mean, most of them, I mean, they are a little bit affordable. Some of them they are like 100 rands per month or so. So you can subscribe to those ones, and you can get access to research that has been done in various industries in various countries. Um, and sometimes also, like, I think to that last point is talk to people. Some people have got, they do research and they just give it away for free. So establish contacts and talk to a lot of people. But unfortunately, as there's no one particular space I can say go to this one particular platform, then you'll find everything. It doesn't exist.
Thank you. That question came from Emmanuel Namanya. Mama Kajaz has a question. She's saying, given Trev's PTSD with respect to JSE stocks, what is your bull case for Purple Group?
Sure. um, so my book case is quite simple. So I mean, also, I mean, on the global stage, right? We are seeing this rise of do-it-yourself retail investors that is being facilitated by technology, right? So now, because people can access, because of technology, people can access relatively cheap brokerage platforms, and um, so they can do the investment themselves. And number two, also because of this rise of research as a service, the one that I just mentioned around, the Motley Food does that. There are quite a number of other people that do that. People can also access research quite cheaply that they previously couldn't, and then they can invest. But the reason why I am investing in the Purple Group is not so much on the brokerage, but um, the more that I think about business these days, right, it's about distribution, right? And distribution has changed, at least in my mind, to from a physical, in terms of physical distribution, to what I want to call like a share of mind, right? And I think with the way that is equity or the Purple Group is building that business in South Africa, if I'm not mistaken, they've got something close to something close to like a million active investors, right? Uh, but to me, when I look at those people, I don't look at them as a million active investors. I'm simply looking at a business that is building a distribution of 1 million people through which they can provide additional solutions, right, at a very, very low marginal cost. So if you look at it, at least from my perspective, right, if you look at it, they've launched, I think it's the property investing leg in that business, and it's easy for them to tap into their customer base because they already have got a very high share of mind around people within the investment space. So once you've got that distribution, you can effectively scale the business and offer more solutions on top of what you currently offer. So to me, if I look at the Purple Group, obviously um, I mean, it depends on how the business is gonna grow. But if you've got 1 million people that are actively on the platform and they use the platform simply because of the stock market, people can log in onto the equity platform probably once or twice or 3 times a day. So you've got a very high customer engagement rate, and then you can then leverage that to push out new solutions, right? So the company has done that with the property investing solution. I think quite a few number of people have been actively involved in that space. I don't see the reason why Easy Equity can't also launch like a buy now pay later solution in South Africa. They already have got 1 million customers, or 1 million active engaged people on their platform. So distribution now to me triumphs, not triumphs, but is probably as important as the product itself. And we're seeing it with a lot of companies that have done it quite well. um, and to me it explains, for example, why Facebook had to pay 17 billion to buy WhatsApp, a company that had no revenue. Right, they were not buying the revenue, they were not buying, probably not the product itself, but what they were buying is the distribution. So you are paying $17 billion to buy 1 billion users, right? So essentially you are paying $17 per user. So once you've got distribution and scale, you are able to introduce more products and monetize them, at a much more attractive, like a unit economics. So that's almost like a nutshell why I started investing in the company.
Okay, the second question is, what is your exposure to emerging markets? Which ones are you comfortable growing with, and within which industries? Do you have a systematic approach to pricing in country-specific risk? And do you mainly consider cross-listed stocks?
Yeah. So emerging markets. So let me say that I've got rather limited exposure to emerging markets. Um, and the ones that I have are, so I spoke about the Purple Group. Right now I also have C Limited, so that's a Singapore-based company looking at Southeast Asia, but it's obviously listed on the New York Stock Exchange. I've got probably that's in terms of, or in terms of emerging markets. I used to have exposure to China, but I've cut it off, simply because of Chinese companies. I struggle with governance issues in China, and every time that I really try to make investments, they really haven't worked. So I struggle with governance issues. So my exposure really is a little bit limited in terms of pure play emerging markets exposures. What I like probably are global companies that are moving into emerging markets, right? So you can have like a US based company or Europe based company, or any of these other big companies that then move into emerging markets. I think that's a comfortable play for me, but it's simply because it's something that I'm not comfortable with. And one of the biggest reason why I've got I've got a limited exposure to emerging markets is there was an article that was once published by Bloomberg, if I'm not mistaken, some years back. And what that article shows is that most emerging markets, the problem that you have is not on the growth of the companies, but it's on the exchange rate, right? And most of the gains that you make in terms of stock market performance, they get like eroded by currency depreciation. And then what you end up having is that after 15 or 20 or 30 years, you know, your portfolio or your investment might have grown in the local currency, but in hard currency, it has probably not gone anywhere. So there's issue around currency exposure that you must, especially if it's a pure play emerging market, like investment. Because so that's really one of the really biggest reason. And some of the emerging markets, like I said, like China, which is one of the, I don't even know whether I could call it an emerging market anymore, but just pay attention to issues around governance. There are a lot of companies there that because some of the regulatory issues are not enforced. There's a lot of governance issues that arise from those particular markets. But that being said, I think emerging markets are really are going to drive a lot of value creation over the next 10, 20, 30 years. I think as an investor, just find your sweet spot, what works for you. You can get direct exposure to emerging markets if you're comfortable with that. Um, uh, for me, I'm more comfortable with global companies that move into emerging markets. But anyway, just find your own sweet spot, and yeah, I think there's a lot of value to be created over the next decade or two.
So you've sort of also answered Anya Bope in terms of what is your view on China markets. So I think because you've touched on that, I'll move along. Sir Boring is asking, ask the tech bull of Zim, how did COVID influence his investment decision, especially when seeing a stock is overvalued?
Yeah, I mean, COVID. It's a little bit of a. I mean, it was a little bit of a once in a type of a decade type of event, right? That is almost very hard or impossible to predict. But I think what we saw in COVID, just answering the question, is that if you compare this particular crisis to the ones before in 2008, which was the financial crisis, or the 2000 or 99 2000 dot-com bubble, is in this particular crisis, the one this pandemic, what we have seen global is that the federal governments and the central banks this time around, they acted extremely quickly in terms of pumping in liquidity in the markets, right? And what that did is that it changed the dynamics around, at least psychologically, around how governments, you know, or government institutions respond to crisis in the economy. Because if you look at 2007, 2008 financial crisis, I mean, it took quite a while, right, before the government really got involved and pumped in liquidity in the market, probably a year or so. I mean, but when the pandemic hit, all right, it took probably a few weeks, probably a month, really, for the central banks and the government to pump liquidity into the market. So I don't know. I don't know whether this becomes the modus operandi going forward, right? So in 10 years' time, if we have another crisis from somewhere, you know, does this set a precedence around how government responds or how central banks responds? I probably would want to think so. That now we are going to see a lot of quick action, right, from the authorities in terms of propping up the markets. So if that's the case, and if you see what happened in the pandemic last year, is that the market really dropped significantly, in the space of a month, and then by the time we got to April, it was really bouncing back, right? So it took a month or so, between the tops to the troughs, and then the bounce back. If you look at 2017, 2018, it probably took like 1.5 to 2 years, right? That entire journey. So if governments are going to respond quickly moving forward to any form of pandemic or any form of market crashes, I think then the key takeaway is that stock price or market drops might not last for that long. So as an investor, you must always be prepared, to act quite quickly. So that would be my probably one of my takeaways from this last. Oh no, I can't call it last. It's still current, the current pandemic that we are facing.
David Ruodo has a question. What are Trev's views on investing in unit trusts / ETFs versus individual stocks as a start?
I would say ETFs definitely. I always think that if you are starting to invest, start with ETFs. I think individual stocks are sometimes maybe we overhype them, and they are not the right for every investor. But start with ETFs, get some skin in the game, and then you can graduate from there.
The other question is from Sibusiso. The first question you sort of answered. The second question is, what do you think of IPOs? Do you invest during IPOs or do you wait before investing?
I mean, it's statistically speaking, it's always a bad idea to invest in an IPO. So statistically speaking, if you look back into history, I might be mistaken, but I think 70% of people that invest in an IPO on day one or day two or week one or week two, they end up losing money, at least within the first 12 months. So statistically speaking, it has always been a bad way to do it. And there are various reasons why it was like that. But again, this is a historical lens, right? Going forward, I think there are going to be significant changes on how the IPOs are done, and the US SEC, which is the Security and Exchange Commission, they've approved to allow direct listing of companies all simultaneously raising capital, and that new legislation is going to open the door for retail investors to get access into IPOs at the same pricing that institutional buyers used to have. So I think that's going to change the dynamics around how IPOs, or how people should think about IPOs. Um, I don't think there is a right or wrong answer around IPOs, but I think as an investor, just be careful of not getting sucked into the fear of missing out, and because sometimes a stock can IPO, and then it can go up 100 or 200%, and then you if you're not careful, you might buy it right at the top, So I mean, generally speaking, probably I would think about it like, it really depends on on your comfort level. So once you read the S1 filing and you look at the valuation, does it make sense at that particular moment? If it doesn't, if you think that the valuation has gone bonkers on day one or week one, just let the stock like settle down for a bit, and then look at opportunistically investing in that particular company. And then, I mean, as also to your point around dollar cost averaging, so use that to your advantage, and always take small small bites, in terms of investing in the company, and then dollar cost average. But yeah, it's a little bit of a tricky subject right now, because the IPO market has been systematically been biased in favor of institutional investors, and against retail investors. But I think the new legislation, especially around direct listing and opening up access to IPOs to retail investors, is going to change the dynamics.
Sure, Trev. We're getting so many questions, I think, but we're almost done. So Tafadzwa says he's from Zim. A lot of platforms don't allow opening accounts to invest in the New York Stock Exchange. Are there other methods one can use to invest in the New York Stock Exchange when based in Zim?
The short answer is that, I mean, I mean, as you know, I'm also from Zim, but the short answer is that, unfortunately for Zim, the reason is like that is because there's some sanctions on the country, and those sanctions, what they do is that they prohibit, if you're a resident in Zim, if you're a resident in Zim, from having access to the US capital markets or Europe capital markets. Unfortunately, these are things that are beyond our control. So are there ways to get access to those markets? Probably the most practical and feasible way is to do it via unit trust in South Africa. I think, if I mean, I stand corrected, but I think there are quite a few South African based unit trust managers that allow people from Zim to invest in their unit trust. So you can look for global funds in those in South Africa, and then that will give you some indirect access. Unfortunately, if you are a resident in Zim, it is what it is. You are not allowed to get access to the US market directly from Zim. Yeah.
I'm not sure if you'll be able to answer this, Trev. It's from Monash. He's asking, what other baggers have you seen in the Australian market besides the buy now and pay later?
It's like I said, I can't talk about specific companies in Australia because of conflict of interest. Um, but the market, so buy now pay later has been growing quite big, but you know, and there's a lot of competition in that space. There's also Australia also. I think companies here are very well positioned to to really make money in the online sports betting in the US. So there are a number of Australian companies that are going into that space simply because Americans didn't have that experience or institutional knowledge of how to run an online book, online sports betting and iGaming book. So there are a lot of Australian companies that are, trying that are really moving into that space. So I think it's also one sector that people should look at. Um, Another one in terms of sectors, there's a growing number of. The market here is not as big as the US market, but they're also growing in terms of fintech companies, also payments companies. There are also quite a few payments companies that are listed on the ASX. So yeah, I think probably those are the top three ones I can think of.
Thanks, Trev. TG is asking, what was the name of the blog that you mentioned at the beginning of this session?
I think above the crowd. So if you just type above the crowd, so it's Bill Gelly is the one. So it's called abovethecrowd.com. Abovethecrowd.com, yeah.
There's a question around what are the top 3 books that you would recommend for an investor to read?
The first one is the book by Dorsey. Is it Patrick Dorsey, right?
Yes, Pat
Yeah.
Dorsey.
Which is like a little book that built wealth, because in that book he specifically talks about how do you think about business models and competitive advantage. So I think that's really the first one that that's always the one that we can share some of the links after this spaces, but it's one of the books that I always recommend if you're starting out, and I like it because it's a very easy to read type of book. So you don't need a finance background at all to understand. So it's very very easy to read. So I read that one and also read 100 Beggars by Chris Meyer. That's also a fantastic book in terms of how to think about and spotting multi-bag opportunities. Um, yeah, I think on face value those will be my top two, really top two books: 100 Beggars by Chris Meyer, and then a little book that built wealth by Pat Dorsey. Yeah.
Right. I think we've gone through all the questions that we had, Trev. Um, from my side, I just want to say thank you to each and everyone that joined the space session tonight. We really appreciate your input. Sorry about the setting issue, which wouldn't allow people to be speakers on the session. I don't know what happened or what's going on with the settings. But thank you for all the questions that have been submitted, and thank you for participating. To Trev, words can never say just how thankful, grateful um, we are that you took this time out. I know it's early morning on your side and you just woke up literally to attend this session. from Australia. So thank you so much for taking the time out. Sharing your knowledge and what you know. I always say I always leave after having a chat with you, leaving so I feel refreshed and so enriched in my knowledge and how I look at the world of investing. So thank you very much for just allowing us the space to come on here and share your knowledge.
No, thanks, S. I mean, it's always. I mean, we're all learning, so it's it's always one of those spaces where we're all learning, and most of us we are really trying. We started late. We are playing catch up, but I think the world is things are getting better around the world, generally speaking, and I think opportunities are being made available to a lot more people than that barriers are being broken down and opportunities are being made available to a lot more people. So it's a journey that we are learning, and there's no one way, there's no correct way of doing it. Just invest in a way that reflects your views of the future, and also invest in a way that makes you sleep better at night. I think those are the two most important things. And then, obviously, I think with time, late time and late compounding work do the heavy lifting for you. And yeah, hopefully in the next 10, 15, 20 years, you can look back and smile.
We want to be smiling. We want to create that generational wealth. Thank you, Trev. Thank you, everyone who joined the space. And good night and good morning for you, Trev. But good night, everyone. Thank you so much for joining the session. I think it was very valuable. I certainly found it very valuable from my side. I still learn each and every time we speak. So thank you, everyone, and good night.